Hello student, welcome back to balance sheet overview. We are going to learn about equity. We have already discussed about current asset, long-term asset, current liability, long-term liability. Now it is our final discussion with regard to balance sheet overview. So let's jump to the topic. So what is equity? Let's read it out the definition. Equity represents residual interest. Residual interest of company asset after all liability have been deducted. Liability has been deducted whether it is current or a long-term liability. It reflects owner share. This is owner share of in the company. In liquidation, equity is amount of theoretically distributable to owner. So whatever is in the equity, this is owned by owner. This is basically owner's money. So as I told you, whatever founder and owner has investing their money into particular business, so business will consider it as a liability or equity. Current asset is your asset and this is your liability. For example, you paid 10 million, so 10 million will be added into your current asset will become 10 million, cash will increase by 10 million, next side liability will be increased by 10 million. Liability in the sense your equity. If you add and this one will be minus, then the total impact would be zero. So balance sheet will always be equal. If you see this way, asset and liability and equity will be 10 million, this will be 10 million. So ultimately 10 million, 10 million. Okay, so both the side is equal. Equity is nothing but a liability. I'm always saying equity is nothing but a liability of for this business. Business receive this money from owner. For example, if you receive from any of the person or individual, if he is paying you, so your cash will increase. What will you do? You will pass cash, you will debit, and you will credit what? You will credit your current liability or long-term liability, whatever the liability is, because you are now creating your obligation that will be paid by you later on. So apart from this, you will pay some kind of interest. That interest is nothing but your residual interest. That is why this obligation is, since this has not been paid by person, this has been paid by owner. That is why this will be given another name like equity to make it more clear. So what are the item available in equity? There are all listed item, whichever possible I have listed out there. I don't think anything else is remaining. Capital stock, then you have additional paid in capital, return earning, accumulated OCI, okay, and non-controlling interest. So these are the item of your equity. Let's understand one by one what is capital stock. So capital stock will be common stock and preferred stock. Common stock will be represent the ownership in company and include voting right. Common shareholder are typically entitled to dividend, but there is no guarantee. You will get dividend when management will decide. So now we will talk about preferred share, represent the ownership similar way of company and with a higher claim on asset. Higher claim in the sense when your company go through merger or acquisition or company is being sold, so that time first this guys will be get paid, and before that also all the liability and other stuff will be paid, like current asset minus liability, other current liability and long term liability. Then you have equity equal to zero. In the equity you have common share and preferred share. When you are selling your assets, so first you will pay your current liability and long term liability. These are the first contestant for your payment. They will get their payment first, then after whatever remaining will be paid preferred share first, then you will pay the common stockholder. So this is the end last time, so his risk is high. Okay, that is why his reward will also be high. So normally they receive dividend as a fixed amount. Their dividend are on normally fixed terms of percentage, and they have priority as I have mentioned over the common stock. And in case of liquidation, whenever the liquidation process will happen, they will be preferred before then common stockholder. That is why his name is also preferred share. So while giving the name, it will keep you remember that preferred shares are always being preferred. In case of liquidation, first they will pay, then remaining will be paid to common shareholder. So this is the overall definition of share. Now we have additional paid in capital. What does it mean? For example, company has issued a share in market for their par value. You might have heard this name. Par value is $1 or 10 rupees. And if you are buying from market and you are paying $10 or 100 rupees, so 10 minus $1, 100 minus $10, this is 9, this is 90. So this is your additional paid in capital, APIC. So this will remain under equity but that is the extra amount you paid based on their par value. So this par value related stuff will be in your common share, and this part 90 and 9 will be part of here. Suppose you have purchased 10 shares, so $10 will go here and rest $90 will be charged here. For Indian point of view, if you purchase 10 share, 10 into 10, 100 rupees will go into your common stock. For 10 number of stock will be issued to you. You are the owner of 10 share, and your additional amount what you have paid is 90 into 10, 900 will be in your additional paid in capital. So this is how it normally works. So if you buy any share, let me show it to you for better clarification. See this, what is their exact value. Market is trading currently 1085 and Indian rupees, and this is their overall overview. But we are going to learn about this is the face value. Face value is normally mentioned on bond and other financial instrument, but here also they have mentioned face value, but that face value is actually the par value. So normally India, when you issue any share in market, that time your face value should be, or par value should be 10. After when you are splitted your share, that time it become, they might have splitted their share into 5, so that is why it become 2. So this is what exactly the par value. Similar way being followed in USA and everywhere. So let's jump back to the topic. As you can see, the face value of par value was 2 and the price was this. What will happen? This minus 21078 will go to additional patent capital equity section, and this 2 will go to capital stock. This is what exactly happened. Also one more point is this 1 or 2 whatever the par value or face value, that is the minimum amount to be paid by the company when you buy company. If you buy a share of Tata Motor or maybe Microsoft, for example, you purchase in $100 and their face value or par value is $10. So when at the time of liquidation, your minimum you will get at least $10, or maximum depend on after paying all the liability and preferred share. Okay, whatever the remaining amount, that will be divided into number of share. Every person will receive excess of, if it is excess, if it is coming 120, so everybody will get $120, whether you have purchased into $100 in market it is showing 1200 or something, but at the time of liquidation, after paying all the liquidity and preferred share, whatever the balance amount is remaining in equity, that will be divided by total number of share, and then whatever the amount is coming. So I am assuming if it is coming 120, so you will get 10 is minimum you should get at least, but if it is coming more than that, so you will get 120 instead of 1200. But before liquidation, if you sold those share into the market, okay, in market from where you have purchased, that time whatever the price is, maybe the price has dropped down to 150, so you will receive 150, or maybe price has dropped down to $80, so you will receive 80, whatever amount irrespective of amount you have purchased, but you will receive as based on market current price. And if it is going to increase by $2000, then if you sold you will get $2000. Whatever amount you have purchased, that is not impacting to your selling price. This will be your selling price, this will be your purchasing price. But in case of liquidation, as I told you, whatever will be paid, everybody will get the same amount. So this is overall explanation with regard to your additional patent capital. Retained earning is part of your net profit, we are keeping into as a separate, we call this under return earning. There is a current year earning like this and old earning. There must be 2GL. So whenever you see current year earnings, so this is directly linked with your income statement. Revenue minus all your expenses, whatever is your net profit is coming, that is linked to your this year return earning. So that will be every single entry. If you pass, if you increase expense, it will decrease. If you reduce expense, it will increase. If you increase your revenue, it will increase. So this will be directly linked with your balance sheet. So whatever entry you will pass, whatever you will do with your income statement, similar thing will come into your current year earning. This is how balance sheet is linked with your income statement. And as I told you, balance sheet, all GLs are permanent account, and these are all not permanent. So this has been divided into two different, real and nominal. So this is not our topic, golden rule kind of stuff you might have learned when you were in graduation or something. So we have discussed about retained earning. Retained earning is your earning which is being retained, or your net profit which is retained, you have not paid as a dividend. Whenever you will pay dividend, your return earning will go down. As I have told you in the dividend payable related entry, how we do, we paid cash and we reduce the dividend payable, and this will be the final entry. But before dividend has to be declared, for those also we will debit our return earning, okay, and we'll credit debit dividend payable. Dividend payable will be credited, return earning will be debited. So this return earning is in your balance sheet equity section. Whenever you debit this, that will be decreasing. Whenever you credit this, it will be increasing. I told you with regard to income statement also. So net profit is all your credit amount, okay, minus amount. So this minus amount is linked with this return earning minus amount. When this minus will go into this minus, so this will be keep on increasing. Assets are always positive and liability and equity are minus related entry. Whenever you post the credit entry, it will increase. Whenever you post debit entry, it will decrease. Just reversal. Whenever you post debit entry, it will increase. Whenever you post credit entry, it will decrease. I hope it is clear to you. That is why when you debit return earning, you are debiting, it will decrease. So it will decrease, and whenever you debit return earning, it will keep on decreasing. You will get your dividend payable. This is how. Whenever we pay to the owner, their ownership will be decreasing. This is how it has been designed. This is all logical. And whenever I'm saying something, if you are not able to follow me, you again this content and try to understand it. Then maybe you feel it is quite difficult or something, but if you rewatch it, it will be better for you. So now we are going to learn about accumulated other comprehensive income. I have briefly explained. Basically, accumulated other comprehensive income are, they actually don't include gain and losses in net income, but recorded directly into equity section. So what actually I'm trying to say, those gain or loss which we cannot book into income, we cannot able to realize that. So we need to book the fair value of our securities kind of stuff. For that we cannot book revenue because it is unrealized. So that is why we have other comprehensive income. I hope it is clear to you. Whenever you are not able to realize gain or loss based on the revenue recognition principle, for security amount has been increased, since we have not sold it, so we cannot realize this income. Otherwise you have to pay tax, and we don't want to pay tax because security price is increasing this year. Maybe next year it will go down, we don't know, or may increase further. So we cannot pay every time tax, and if it is going down, we'll pass the adjustment entry and we'll ask a government to pay back the tax, or will take credit of tax. This kind of thing will be quite difficult. So that is why it is also, the another logic is, this is not recognized by revenue as per the revenue recognition principle, and we have not actually earned this. Okay, so that is why we have to book into equity section whatever the profit is, because ultimately net profit will go to your retained earning or equity. So that is why unrealized gain on available for sale security, these security are available for sale but we have not sold. Now if you talk about treasury stock, those stock we are buying back from market share. This is normally company do when they see their is market is going down or market share price is down, and you are the business owner and you know about the potential and about the company and your business plan kind of stuff, where you are going to invest and what is the reason you are not generating profit of it, but you know more about your business. So that time if you see that market is going down, so that time you buy back all your share as much possible. So that is called, that will be in your treasury bond, that will be their par value will be reduced from this capital, and a difference will also be reduced from your additional paid in capital. When we will go into that chapter, that time we will learn in more detail. Non-controlling interest is something, you have your own subsidiary, you hold 80% or you hold 90% of ownership of that subsidiary, but 10% since you don't hold, so that is not your money. So that is why this will be your non-controlling interest. Equity in subsidiary that are not wholly owned by reporting entity. Okay, the parent's company is your reporting company. Parent company is not holding completely. So that is why this 10% of their value will be in your equity as a non-controlling interest. I hope it is clear to you. Reduce the total equity value, equity because repurchase the share obviously, and share are no longer outstanding. That if equity is reducing, that doesn't mean owner share is decreasing. No, this is not the part. Basically you have asset, you have liability, you have equity. Under equity there is retain earning, treasury stock, common stock. So if you club all together, it will be your equity. So in common stock, maybe you are keeping 10 million of share, and rest the market are keeping 10 million, and the difference is in your additional paid in capital. And when you saw that market is going down, that time you buy 5 million share from market. So what will happen? This, instead of 20 million, it become 15 million. But your asset side, your cash will go. So your asset will reduce, your equity will reduce for similar value, but your part with regard to company ownership will increase internally, because earlier you were holding 10 minus 10 divided by 20, total equity share was 10 plus 10, 20 million. So you are holding 50%. Now since you have buy back 5 million share, so now total, still you are holding 10 million, and now this is 15. So your percentage will increase. How much percentage? Let's calculate this. 5 multiply by 6, 15 multiply by 6, 90, and then again 10, 6.66. This is your percentage, 60.667. So now your percentage has been increased. As you can see, overall equity is going down, but and your asset is going down, but your company ownership has been increased. So this is how owner are keep on trying to increase their ownership. I hope it is clear to you. I think I'm done for the day. We'll see you into the next session. Thank you very much. Stay tuned.